All right, folks, buckle up. Are you sleeping on the biggest investment opportunity of the decade? Or are you walking into a financial trap set by, well, let's just say complex global forces? Today, we're asking the tough questions. Is the DeepSeek buzz a green light for a China tech stock explosion? Or are we about to see a market meltdown? We're breaking down the good, the bad, and the potentially very, very lucrative. Stay tuned. The news is buzzing. DeepSeek has made a significant leap forward in AI. We're talking performance metrics that are turning heads on both sides of the Pacific. But what does this really mean for your wallet? The immediate reaction? Speculation is rife that this breakthrough will supercharge the entire Chinese tech sector. Investors are scrambling to find the next big winner. But hold your horses. Before you throw your life savings into the market, let's dissect this a bit. Let's start with a seemingly unrelated issue. The dreaded, "Are you a robot?" CAPTCHA. Think about it. Why are these becoming so prevalent? It's a symptom of a larger problem, the constant battle against malicious bots and automated attacks. Now, how does this relate to DeepSeek and China tech? Well, as these technologies advance, so do the threats. Increased reliance on AI means increased vulnerability. If websites and infrastructure become unusable due to bot traffic or security breaches, the entire ecosystem suffers. Imagine a flash crash triggered by AI-powered market manipulation. The stakes are high, and the risks are real. The direct impact of these robot checks is frustration. Pure, unadulterated frustration. You're trying to buy something, access information, or simply browse a website, and you're met with an annoying challenge. Wasted time, missed opportunities, and a growing sense of distrust in online services. It's a terrible user experience, and it's driving people crazy. But it's also a sign of the times. The internet is under constant attack, and security measures are becoming increasingly intrusive. For website owners and businesses, these security issues translate directly into lost revenue. If potential customers can't access your site or complete a purchase, they're going to go somewhere else. It's that simple. This means increased support requests, damage to brand reputation, and the need to invest in better bot detection and security measures. The result? A boon for security companies and a headache for everyone else. It's a constant arms race, and the costs are rising. On a broader scale, these security hurdles erode trust in online services. If people perceive security measures as overly intrusive or ineffective, they may start looking for alternative, less secure methods. This could lead to a resurgence of older technologies or a greater reliance on offline interactions. Furthermore, if businesses are disproportionately affected, especially smaller businesses reliant on online sales, it could lead to economic losses and increased anxiety about the growing sophistication of bots. Now, let's pivot to Marvell Technology. The stock took a hit, dropping over 7%. Ouch. What happened? Investors got spooked. The semiconductor sector is notoriously volatile, and any sign of weakness can trigger a rapid sell-off. Marvell's decline highlights the risks associated with relying on specific customers and navigating a fiercely competitive landscape. Is this a canary in the coal mine for the entire sector? Should we be worried? The immediate impact of Marvell's stock drop is felt by investors and employees. Shareholders see their investment value decline, while employees may experience decreased morale due to concerns about the company's future. This can lead to increased scrutiny of the company's financial performance and future prospects. No one wants to see their hard-earned money disappear, and a stock drop like this can be a real wake-up call. Marvell's was cast a shadow over other semiconductor stocks, particularly those reliant on similar business models or facing similar challenges. It also puts pressure on Amazon to demonstrate the value of its investment in custom chips. Conversely, competitors of Marvell might see a slight boost in demand. The key takeaway? The AI chip market is a battleground, and only the strongest will survive. This could lead to a shift in investment towards AI stocks perceived as having higher growth potential. The broader socioeconomic impact is heightened investor caution regarding semiconductor stocks and the AI chip market in general. This could lead to a redirection of investment funds towards other sectors or asset classes. The article implicitly highlights the importance of AI investments in the current market, further fueling the AI hype and investment cycle. It's a self-fulfilling prophecy. The more people talk about AI, the more money flows into it. Finally, let's address the elephant in the room: Wall Street's recent slump. Worries about inflation and potential tariffs are weighing heavily on investors' minds. This creates a climate of uncertainty and fear, leading to market volatility and potential losses. Are we headed for a recession? Are trade wars about to escalate? These are the questions that are keeping investors up at night. The direct impact of a market slump is felt by investors, particularly those with significant stock holdings. Losses in investment portfolios can be devastating, leading to increased anxiety about the state of the economy and potential delays in retirement or other financial goals. It's a stressful time for everyone, and it's important to stay calm and avoid making rash decisions. For financial institutions, market volatility translates into increased instability. The Federal Reserve faces pressure to respond to inflation concerns, while economists and analysts are under pressure to interpret the data and predict future market movements. It's a high-stakes game, and everyone is watching closely. On a societal level, a market downturn can lead to decreased consumer confidence and a reduction in spending. This, in turn, can slow down economic growth and potentially lead to job losses. The mention of potential tariffs raises concerns about increased prices for consumers and potential trade wars. It's a complex web of interconnected factors, and the consequences can be far-reaching. Let's drill down on the specific risks. Technically, we're looking at website accessibility issues caused by overly aggressive security measures. Excessive bot traffic, cookie problems, and false positives can all prevent legitimate users from accessing websites. Furthermore, Marvel's reliance on custom chips from Amazon creates a dependency that could backfire if Amazon changes its strategy or experiences production issues. From a business perspective, the market is incredibly volatile. Earnings reports, guidance, and overall market sentiment can all trigger rapid price swings. The AI chip market is fiercely competitive, with companies like NVIDIA vying for dominance. Finally, economic uncertainty caused by inflation and potential tariffs creates a challenging environment for businesses of all sizes. We also need to consider the ethical implications. AI bias, data privacy, and job displacement are all serious concerns. Companies developing and deploying AI technologies need to ensure that their systems are fair, transparent, and accountable. They also need to consider the social impact of their technologies and invest in retraining and education programs to mitigate potential job losses. And let's not forget the potential for misleading investment advice. Be wary of hype. So, back to the original question. Is DeepSeek's breakthrough a legitimate catalyst for a China tech stock explosion? The answer, as always, is complicated. There are significant risks to consider, from security concerns to economic uncertainty. However, there are also tremendous opportunities for growth and innovation. The key is to do your research, understand the risks, and make informed investment decisions. Don't get caught up in the hype, and don't be afraid to ask tough questions. What should you do right now? First, diversify your portfolio. Don't put all your eggs in one basket. Second, focus on companies with strong fundamentals and a proven track record. Third, stay informed. Keep up with the latest news and developments in the AI and technology sectors. And fourth, consult with a financial advisor to get personalized advice tailored to your specific needs and risk tolerance. This isn't a get-rich-quick scheme. This is about long-term, sustainable growth. The world is changing at an unprecedented pace, and AI is at the forefront of that change. Embrace the change, but do so with caution and a healthy dose of skepticism. The future is uncertain, but one thing is clear. The companies that adapt and innovate will be the ones that thrive. So, are you ready to ride the DeepSeek wave? Or are you going to sit on the sidelines and watch the opportunity pass you by? The choice is yours. Ultimately, investing in China tech stocks, spurred by DeepSeek or any other AI breakthrough, requires a balanced perspective. Acknowledge the potential for significant gains, but never underestimate the inherent risks. Political factors, regulatory changes, and global economic conditions can all impact the market. Stay vigilant, stay informed, and stay prepared. And remember, only invest what you can afford to lose. Now, let me know in the comments below. Are you bullish or bearish on China tech? And what are your biggest concerns? Let's start a conversation.